Yeah, sure. So I started my career with a company called Merrill Lynch in New York, and I moved to Hong Kong in 2006, just 2 years before the financial crisis. I really got very hooked to value investing in 2008 during the financial crisis when I saw this pandemonium in sort of the Asian financial markets. They drew me to investing. I started reading the early Buffett partnership letters. And that was kind of my start. So about 10 years ago, went to NYU for my MBA, New York University, Stern School of Business, where I took a lot of very interesting classes with Professor Damodharan. I worked with a Columbia Business School professor in New York, Jeff Graham, who's the author of Dear Chairman, and that really got me hooked. And I wanted to apply what I learned back in Asia. The markets are very inefficient. My personality, I think I'm a very person. I've lived in 5 different countries, currently based in Singapore. I'm just curious about the world. I've well-traveled, and I like numbers, so. Yeah, I don't think anyone can be Warren Buffett or Phil Fisher or, Seth Klarman. So I just try to be myself. What I think works for me is I look for trying to understand what the downside for any stock is. Understanding the downside is very important for me. So if I'm wrong, which I'm going to be at sometimes, how much money can I lose? So I try and spend a lot of time there. And then what I try and understand is I'm very attracted to growth in Asia. So small companies that can become big companies. So after I understand the downside, I want to understand what the upside from this company is, where the earnings can grow. The more defensible the earnings, the better it is. So my style, I would characterize it as a value investor, making sure the downside is somewhat protected, and of course I like the upside with the earnings growth. So I think a combination of a few different value investors. Risk to me is taught wrongly in business schools. Most people in business schools teach risk as a standard deviation, a beta, or the Sharpe ratios, etc. To me, risk is really the risk of permanent loss of capital. So losing money, or sort of not mark-to-market fluctuations, but permanent loss of capital. And that's what I said, Pablo, earlier, is I look to understand what the downside risk is for any particular business. So that's how I evaluate risk. There are various types of risks. I have a checklist that I go through. There's revenue risk, there's competitive risk, there's regulatory risk, there's country risk, there's all sorts of risks. So I typically have a checklist to keep me very disciplined on understanding what the risks are to a business. When I started out early as an investor, I used to think, macro was not very important. I was just a very fundamental investor. But I think, as an investor in Asia, the countries, whether it's Japan or India or China or Thailand, they're very, very different countries. They have different tailwinds, they have different headwinds. And so macro is a very important part, especially for me to understand the downside for a company. So I do pay attention to the macro, but it is really to understand how the macro impacts the fundamentals of a company. Concentration is a double-edged sword. Of course, if you are Charlie Munger used to have 3 stocks in his portfolio. Peter Lynch used to have a much more longer tail. I think that having 3 stocks in your portfolio, clearly, many investors are not going to invest with you. But so I think of it as a double-edged sword. I'm personally, I believe, a concentrated investor. I like to have between 12 to 15 stocks in my portfolio, but that's primarily because I fish in small caps. I think concentration is great when it works, but it is a double-edged sword. Only to be used when you can find no-brainer ideas. In the current market environment, I don't think you have a lot of no-brainer ideas, so it makes sense to have a little more diversification. I'm a very long-term investor at Amiral. We practice, looking at companies as if we own these companies and not just as pieces of paper or stocks that you trade. So we tend to be very long-term, which fits my style as well, very long-term. So the turnover tends to be quite low. We sell an investment in three cases. One is when the valuation has reached our threshold. 2 is when the facts change, the facts for the investment change, and 3 is when there's been an error in the initial thesis. So really it's just assessing all three of those. My view on cash is it's nice to have during a financial crisis, of course, but no, cash is not the greatest asset. You know, if you know, in Asia you can find lots of very interesting small companies that have the potential to become big companies. So my preference would be to own a stock, a company that can compound capital. But really, if you can time the financial crisis, you want to have as much cash as you. So I meet, over the last 12 months, I've met over 150 companies. I track about 150 to 200 companies, of course, about 50 or 60 of them, which I know really, really well. But what I tend to do is I start with a sector and then I try to get to know all the companies in that sector in Asia. And so my idea generation is a few different ways. The first is just the companies I know. You know, I track 200 companies or so in Asia. The second is, you know, we have a pretty wide network of very good investors we speak to frequently. You know, I look for special situation ideas. So ideas can come really any different way, but one of my main sources is the companies I've got to know over a very long period of time, because the margin of safety is just getting to know the companies very well. I think talking to management is very relevant, especially for the small caps. It's less relevant for the big caps, the large caps. It's relevant for the small caps because you bet on the right management, typically you're going to make lots of money, because, you know, companies like, say, in India, you really want to find the right manager. He could create lots of shareholder value for you. So typically, it's very important in small caps. I try and talk to management also to try to understand if they're making up a story. So my questions tend to be trying to understand the true story, and so the integrity of managers. So you know, because typically before I meet management, I've already done a lot of work on the company and I already know a lot. So it's really about fact finding. So I find the exercise of speaking to management very, very helpful. Mistakes are just a part and parcel of investing. They are very, very important. I think the most important way is to write them down. You write all your mistakes over a long career. As long as you do that in a very disciplined manner, it reminds you. I think one of the great things about Amiral is we also have this each year, each sub-portfolio managers are supposed to discuss their biggest mistake that particular year. So the company actually forces you to kind of recognize your mistakes in front of people, and that teaches you a lot. Actually, some of the best lessons I've learned are from prior mistakes. Of course, you want to minimize your mistakes over time. Yeah. I think the biggest mistake is because we're human beings. We tend to have this, you know, once you make up your mind, it's very hard to kind of reverse your mind. You know, some people find it hard. So I think early on in my career, I think, you know, you don't want to fall too much in love with a stock. That's a mistake. So now these days, I tend to have a little more of a skeptical hat, trying to make sure, you know, I find a bear who has a very opposing view to me, and try to tear down the thesis. You know, that's I think the most common mistake. Just falling in love with the company or falling in love with the product just because you know the company for 10 years, you think that there's a margin of safety. So just being humble, you know, and just kicking the tires and always trying to listen to the other side. Well, Asia is what Europe was about 15 years ago, which is very inefficient. Asia is what the US was when Warren Buffett was running his partnership days, which is 1960s, maybe 1970s or 80s. You know, the point is that I had many career options to stay in the United States, but I knew that my biggest edge was going back to where the markets were inefficient. There's 10,000 listed companies, maybe more in Asia, and the fund management community and the sell side community is still quite, it's not to the same level as Europe and the US. So the one thing I've learned is sort of you want to pick your spots, you want to fish in very less competitive spots. And so if you can find good managers in Asia, you know, Amiral Gestión, where we invest in inefficient markets, that's really where, you know, that's where you can make alpha. My visit to Spain, and I'm looking forward to visiting many times in the future. It's really a wonderful country. I think I'm very amazed by the value investing community. It's something that you don't expect, when you come to Spain. It's certainly actually much stronger than even Asia, Hong Kong and Singapore. They tend to have a lot of investors, but I don't think it's as rooted. So that's something that's really surprised me about Spain, and I could see how people are truly passionate about value investing, which is different from just the typical hedge fund you see in Hong Kong or Singapore. My favorite books, from an analytical perspective, is a book called Creative Cash Flow. It teaches you how, my favorite metric is really cash, understanding how companies generate cash. And so this book is a very deep dive on understanding how companies, what the true source of cash is. And I think this is a great book. Of course, Principles, recently I read Ray Dalio. That's a great book. It teaches folks about how to be very organized and just have a very disciplined process. So those are some of my favorite books.